Hi, welcome to the PropWealth podcast, a series for landlords and property investors of all sizes. I'm Sam Murphy, independent financial advisor and mortgage expert.
And I'm Heather Hilder, portfolio landlord and owner of a sales and lettings agency in Hove. So, Sam, I've got some questions for you this time round.
Oh, should I be worried?
Tell me, does property still work as part of a pension strategy? And would people actually think of property as part of a pension strategy?
Oof, I mean, that's a big question. I think we should probably start in the past. I think we had so many people, accidental or opportunist landlords thinking, I can keep hold of my current property, turn it into a rental property and then buy a new property for the family or for me to live in. Not me, for them to live in. Mm-hmm. And that's got harder and harder. We spoke about this on a previous episode. 5% additional stamp duty on the onward purchase makes doing a let to buy pretty tricky. So that was a really common way in which people thought, well, I'll keep that property as an investment and that will go towards my pension and retirement planning in the future. But also lots of landlords that deliberately went out there and built a portfolio, one or two or more properties, with the idea that it would generate a passive income which would see them well into retirement and ideally pay the mortgages off if they needed them during their working life so they could enjoy the rental income. Is it still part of a pension strategy? I think definitely yes, property still has a part to play. I think it's fair to say that a lot of people are a bit down on property at the moment as an investment just because prices have done incredibly well in the past and we don't see that same level of performance in the last few years, maybe going back a few more years if you're judging property values against inflation. And markets have done particularly well. So if you've got a pension fund, a workplace scheme or a private scheme, you'll probably, if you're checking in on your app or you're seeing your annual letters come through, you'll have seen really impressive growth. And we haven't really had any stock market crashes or recessions since 2007, 2008. So if you're comparing them side by side, there's a lot in favour of pension funds at the moment. I should caveat, nothing in this episode constitutes advice. I have to say that every time I stray into this territory. So it probably does have a part to play. I think where some landlords have come unstuck is where they've put all their eggs in one basket. And as an advisor, one of our core principles that we say to every client is it's about diversification. So diversification of asset classes. So not everything in property, not everything in stocks, not everything in the same stock. Just because you had a tip about, I was going to say Tesla, maybe that's not very topical at the moment. But, you know, concentrating your investment concentrates your risk as well. And that's why I think landlords who have got everything invested in property will be feeling a little bit nervous at the moment about, is this the right thing to do?
I've got a question there because you've mentioned risk a couple of times. How do you measure somebody's level of risk taking? Because, you know, where would property come on that graph in terms of risky business?
Yeah, good question. Property's in a way it's a bit of a wild card because safe as houses on one hand, you can walk up to it, you can touch it, and you know that it's yours, and you can deal with those things yourself, and that has a real benefit to a lot of people. People like the idea of being able to solve any problems themselves rather than being at the mercy of what happens in the markets or anything that's a bit more distant. So property can be really safe. It depends what your expectations are as well. If you're getting £1,000 a month for a rental property, banking on £1,000 a month is risky forever, because you're not always going to get that. You're going to have management costs. They're going to be intermittent. They're going to be unpredictable. But markets are unpredictable as well. So I think property is a different type of risk, and it's about being informed, and it's about being realistic with your expectations. Mm-hmm. In terms of how we judge people's appetite for risk, we have a questionnaire and a scoring process if we're going through a client for investment choices, that will ask questions about what level of risk they're prepared to take. So I think if you go back 20, 30 years, there's a few factors that made people really move towards property as an investment because prices had been doing incredibly well. Yes, there'd been some price crashes in the quite distant past now, really. We've had no real crashes in the last 20, 30 years. We've had a few bobbles, but nothing that people will tell their children about, like there was in the 80s.
And the mortgage interest rates at 15%.
Yeah, the old, my mortgage was 15%. Yeah, but your house cost you 20 grand. So, and then there was the big pension scandals. If you go back, I'm a bit too young to have been working when this was the case, but yeah, the big pension schemes that went pop, people still associate pensions as being risky like that. But of course, the modern pension is a money purchase scheme where you're buying into an investment in the global stock market and global bonds and things like that, not an in-house scheme run by a large company that has the potential to misappropriate the money or go bust and lose your pension with it. So I think certainly people of an older generation than me had that real fear that pensions actually could be really high risk. And so property was a safe haven. I think now the future really is a bit more about balance. We're helping some clients at the moment who've got sizable portfolios, drop off one of their properties, sell a property every year to make use of what small capital gains tax allowance there is now, the £3,000 a year, and then invest that into something that it's not really about the risk for them actually. As people approach retirement age and needing to use their pension savings, it's far more about liquidity as well. So a property, yes, you can get the rental income from it, depending on whether you've got that property mortgaged or not. That might be a lot or not very much, the monthly rental income. But just being able to sort of liquidate that asset and turn it into something that you can keep invested, but you can start dipping into on a more regular basis, I think that's something of real value to people approaching pension age.
For somebody who really loves property but doesn't want to be in it themselves, are there stocks out there that they can buy into that have a property slant at all?
Yeah, definitely. I mean, you could buy the stocks of a house builder, for example, of the big building companies. I'd say that's a fairly risky strategy if you're going all in on a builder. But actually, you've got a lot of what we call multi-asset funds. So the type of investment that a typical pension would be in, it's a real mixture. So every pound you put into a multi-asset fund is split into hundreds of tiny pieces, invested in some stocks in the UK, Europe, America, emerging markets, some really safe stuff like gilts and bonds that are designed to be a bit of a counterweight against volatility. But also a lot of some of the funds that we recommend quite commonly will have 5 or 10% of property in that fund. And one of the benefits of holding property of any form within a pension is that you don't have to pay, there's no tax on the rental income. Now, I should correct myself there, you can't hold regular residential property in a pension, but you can hold commercial property. And actually that's a real interesting point for business owners. So if you run a business and you can buy your own business premises, or you already do, you can transfer that into a SIP, a self-invested personal pension. And if you do so, then the rent that you receive is not taxed. The capital appreciation is also not taxed. There's no capital gains tax. So you can own it within a pension. You can then sell it within the pension when you come to retirement if you want to have a broader range of investments in the future. And then you can draw off it in the future. And obviously when you draw from a pension, then you do start paying tax at your prevailing rate. But for most people in retirement are lower rate taxpayers, 20% or less than 50,000 annual income. Many people who are saving for retirement will be higher rate taxpayers. So if you can shield that asset all the while you're a higher rate taxpayer in something like a SIP, you can then start releasing the value from it in the future. And also SIPs can borrow. I'm going a bit technical now, but you can take a mortgage within a SIP. Yeah. So there's lots of flexibility there for people.
Yeah. Interesting. With the way that the pensions are at the moment as well, and potentially, perhaps not being able to fund pensions in years to come, is this a wake-up call to people to start looking at other investments? So maybe property for a few years. I mean, again, if they had the wherewithal to work out, well, if I bought that, the market improves, sell it, and then put that money somewhere else. Is that a sensible way of doing things, or?
Yeah, I think it's important to, especially if you're I mean, this episode's about pensions, strategy and how property plays a part in that. Whenever you're saving for retirement, it's always a long-term view. So, we talk about one reason property is less attractive now is because of the 5% stamp duty surcharge if it's not your primary residence. Well, that's very hard to get over if you're keeping the property for 5 years. But if you're in your 20s or 30s and you're planning on keeping it to retirement, you've got 30 plus years potentially to eradicate that initial setup cost. And we're a little bit down on property at the moment because interest rates have been higher. Property price growth has not been as good as before, but everything goes in cycles. So, just as you wouldn't sell out your entire pension stocks just because the market had a dip. In fact, that's probably the worst thing you could do. If the market has a dip, don't sell then. Selling when the property market's having a little bit of a dip in terms of confidence, not necessarily values, that could turn out to be a bad idea as well. So I think holding your nerve in any investment scenario is important. Now, that's not to say you should be throwing good money after bad, because if something isn't working for you anymore, you do need to realize, okay, maybe this isn't where I have all of my investments for the future. But no, I think property definitely has a part to play in pension planning, and it doesn't always have to be the traditional view of property as you alluded to there. So, if you're in residential, have you looked at commercial? If you're into buying whole properties, have you looked at being invested in property somehow, but maybe a bit more arm's length, so you don't have to have that responsibility of management and those direct costs. If you can buy into a big company's property portfolio, then you can benefit from them doing all the hard work and you just getting a share of the profits in the future.
So for a young person just leaving university, say, what advice would you give them about pension strategy, property strategy? Would it be worth sometimes buying a property in the north of England, for example, and renting down here if they had to?
Yeah, it's a really good question. For young people coming out of a degree and looking for graduate jobs, especially if they're having to do that in London and other expensive places to live, the idea of getting their own home is incredibly, seems quite far away for them. So, I mean, the one thing I've been a bit on the fence about property in certain discussions here, but the one thing I would say to any young person is get yourself on the property ladder as soon as you can. Any rent that you pay is dead money. It's someone else's mortgage that you're paying. So unless it really suits you because of where you need to be and for a short period of time, renting is probably not something you want to do for any longer than you need to. So buying your own home, whether it's a regular home, shared ownership, there's a few other schemes out there at the moment that are designed to help people get on the ladder. If you get the opportunity, do it and try working towards it.
And getting your credit history.
Yeah, absolutely. Yeah. If it's not possible in the area that you want to live, then absolutely you could look at investing in property in a more affordable area. So if you have no intention of living in the property, but you just want to get on the ladder so you can have a stake in things, that's good. Just be wary though that if you're a first time buyer, you can only use your stamp duty discount once. So if you buy a cheaper property in a cheaper part of the country, and then you come to buy property perhaps with a partner for yourself in the future, then not only will you not have your discount, but if you already own a property, you might have to pay the 5% surcharge on the place you want to live in. So take advice is always the advice there. But yeah, I would say, although property for pensions is maybe not quite the hot ticket that it was, it still has a part to play. And certainly for younger people, it's still an aspiration that I think is worth having.
I think you've rounded that off really well there, Sam.
Yeah, so I'm sitting on the fence all times, basically. So yes, it's good. Yes, it might be bad. Don't have too much of it. Do have enough of it. But thanks for listening.
Comments,
if you've got any questions or comments, please do put them below. We'd love to hear from you and we'll certainly get back to you. Please join us for the next episode.